guys, Dan Frio here, the Mortgage Update, and it is September 18th, the Fed Day. So what happened? Well, the Fed did exactly as what we thought they were going to do, and they reduced the federal funds rate by a quarter, or 0.25%. So the first thing I want to do today is let's look at what happened throughout the day. Okay, so basically we had, this is the mortgage-backed securities, and again, up is meaning the price of the bonds are going up, thus yields or rates are coming down. And then when we see down, it means prices are going down, rates are going up. So you notice throughout the day that they kind of stayed stagnant, and then it kind of ran up a little bit, and it ran up pretty good, because if you noticed here, we started the day at 101.09, okay? And then we ran all the way up to 101.31. That is a huge move, okay? But notice right here, and if you look down at the bottom of my screen at the time, which is down here, follow down in here, right here, the Fed announced what they were going to do at 1 o'clock. Okay, so all the way up until that, rates got better and better and better, extremely better. Okay, then after that, what happened? We got kind of crushed. So we started the day at 101.9 or 09. We went all the way up to 101.3. So that's basically a 20-something point move, which is huge. And we went all the way down to 100.87. I mean, that is huge volatility throughout the day. Right in here, I noticed this. I was actually online when this happened. And I had about 4 or 5 clients closing in the next week or two, and I locked them because I saw this coming in. Right here, we got a rate adjustment, and rates went up 0.1. So I saved these people 0.1 in interest rate, or 0.125. I'm sorry about that. So that's what happened throughout the day. Okay, what I want to talk about today is the federal funds rate. What happens? So basically, here's an analysis or a site that I follow pretty closely, and it gives me a whole bunch of data, what's going on with the MBS markets and so forth. But if you ever watched any of my videos, and hope you have, and if you like them, please don't forget to subscribe. Give me a thumbs up and leave some comments. Let me know if there's some things that I'm going maybe talking a little bit over your head on, or something you really want me to dig down on. So I'm going to read this just so you get what the Fed controls. Okay, so here's what happened is, and then what this means to you. All right, the Fed is expected to cut rates this week, and so what does it mean when it does? It might surprise you. It's from times that the Fed cuts rates, mortgage rates don't respond very well and can actually move higher. That's a phone call I get. I'll probably get tomorrow, 50 phone calls. People saying, okay, the Fed reduced rates. I saw that on the news tonight, so that means my mortgage rate's going down, 0.25%. No, and it could be a reverse of that. Here's why. Why is that? Well, the Fed only controls the federal funds rate. This is very short-term overnight lending, actually between different banks. So what happens is a bank needs to have reserves at the end of each day, each business day. So let's say the bank needs $100 in reserves, okay? And they only have $90. Well, they have to go out to a different bank. So think of it as overdraft protection. They go out there and they borrow the money to make them solvent for the night. That's the federal funds rate. That's the rate that they pay for overnight funds from a different bank. So think of it as, again, as overdraft protection. Mortgages, as you know, can be out there for 30 years. So that's a short-term overnight funds. Okay. Because of this, mortgage lenders are more concerned about inflation, because inflation will erode the buying power of the fixed payments received over time. When the Fed cuts, they're trying to spur economic activity by making borrowing costs for businesses cheaper, as well as other things such as the prime rate. And those are tied to home equity loans, car loans, credit cards, student loans, and things like that. Okay, here's the kind of cool thing, and most people don't know this. And I try to preach this on the channel and explain to you all these details. But hopefully today will show you exactly how this works in inverted kind of sometimes, and what happens with the Fed and then mortgage rates. So if the Fed cut is perceived to be successful in spurring more economic activity, businesses may improve, which then means the pricing, they have some additional pricing power, which can be inflationary. Okay, the bond market may perceive this as bad news for long-term rates, and mortgage rates could actually go higher. Okay, the federal funds rate basically is very, very short-term funds, where mortgage rates are tied to a longer fund or a longer-term bond. So we have often seen times where the reverse of the federal rate hike, where rates go lower. So let me read that again. We have oftentimes seen this is in reverse when the Fed hikes rates, mortgage rates go lower. Okay, it much depends on the comments of the federal chairman after the announcement. So what's going to happen tomorrow is the Fed, all their news is going to kind of get deciphered. Chairman Powell is going to come out and speak, and they're actually going to tell you what their thinking is going in the future. Now, what's done is done, and this has already been baked in to the equation. But what we're looking at is, what are they seeing in the future? What does the future, they're going to give us a little bit of a crystal ball what they think is going on in the markets. Here's what I think. I think there's two inflationary figures that the Fed watches. One's running a little hotter than the other, and thank goodness the Fed is watching the one that's kind of benign at this point. So I think what they're going to say is we're going to let this thing settle. We're going to let the dust settle. We're going to continue to monitor inflation. So I don't anticipate any additional rate easing this year. I could be wrong. I don't think I'm going to be wrong. So that's that. So now let's get on to what happened today. And basically, like I said, we showed you what happened interim during the day. And again, we exactly what we just talked about is right here. The Fed announced, and then mortgage rates went up. Again, down is up is down, because this is the price of the bonds, and so the price goes up, yield or interest rates go down. Prices go down, yields or rates go up. This is a huge move down. Okay, so the Fed eased and rates spiked. Crazy, I know. That's the way it goes. So where we're going to see some resistance right now is here. And if you watch the channel daily, you're going to see we now have a top and a bottom. We're running in between that. I don't think we're going to see any major changes. However, what's going on right now is Iran just bombed Saudi Arabia. That throws all of this stuff off the charts. So now what happens is, if we get involved in any military strikes or anything, you're going to see a flee to safety. You're going to see rates go down. Okay? Conversely, the issues we're having with China. If you see a resolution in the tariff wars, that's going to, and Trump said that it'll spike the stock market 10,000 points. I don't think it'll spike at 10,000 points. I think that was basically sarcasm. He's just saying, we'll have a roll or a run in the market if we see that. But if we resolve things with China, you're going to see rates jump. So again, if we have tensions in the Middle East and we go to war, you're going to see flee to safety. You might hear those words. Flee to safety means people go to bonds and mortgage-backed securities. If people think the economy is doing great and there's no issues, and again, the China trade resolves and everything gets peachy, you're going to see the stock market run. People are going to pull out of bonds and go into the stock market. So if they're pulling out of bonds, that's going to drive the prices down and yields up. If they drive their money or push their money into bonds, that drives the price up and the yields down. So it is not normal markets, and this is something you have to watch on a daily basis. So if your mortgage company isn't doing this, your mortgage advisor is not doing this, he's doing you a disservice. Him or her is doing you a disservice. So that's why I would say this is what I do different for you, do for all my clients. I monitor this on a daily basis. So that's today's report. I hope you enjoyed this. Please don't forget to give me a thumbs up. Don't forget to subscribe, but please leave some comments. Let me know what you want me to dive into. so I can start putting some more videos up here for you to educate you. So take care. God bless. Have a good night.